SmallCapPower's Ask the Expert.
SmallCapPower was proud to be a Gold Plus sponsor at the recent PDAC convention held in Toronto. We thought this would be the perfect opportunity to ask our roster of experts, what's currently holding back the resource sector?
Global demand, in particular, China especially. Resources had a good run because of China booming. China is slowing down, and that has put a dampener on resources demand. But we believe that as global demand picks up in 2015 and mostly in 2016, they should do better.
Obviously, when you talk about a slowdown in China, you have to put that in some kind of context. 7% growth isn't bad, but it's down from 10 and 11. So the slowdown in China is one thing. And I think with gold, the biggest thing that's been holding it back, two biggest things are the dollar strength, but also these ongoing concerns that the Federal Reserve is going to start raising interest rates at some point.
But I think the global economy has really never recovered from the 2008-2009 debacle that occurred after Lehman Brothers' failure and the financial crisis. I think there's been an aggressive response with monetary policy to try to rejuvenate the global economy, but quite frankly, it isn't working. If you look in the United States, for example, the velocity of money is continuing to shrink, just as it did in the 1930s. So we're trying the same policy. We're pushing on a string. They're pushing huge amounts of money into the economy and indebting the economy even more. So if you look around the world, the global economy is really not doing well. China is shrinking. It's maybe not shrinking, but it's not growing very rapidly anymore as it had been. Europe is a basket case right now. And even the United States, which is supposed to be a beacon of hope, is not performing very well. The unemployment, or let's say the number of employed workers in the United States continues to shrink. And there's so much evidence to suggest that we've maybe never even come out of the recession in 2008, 2009. If you use economic statistics from John Williams, an economist, who looks at inflation in a way that I think is much more realistic than what the government talks about. What does it cost to keep a family of four alive? Much higher than 1 or 2%. Williams' numbers are 8 or 9%. So if you take 8 or 9%, factor that into GDP, we've never had a positive GDP since 2008, 2009. I think that's more realistic, and I think that's the reason that the metals are having a difficulty, is because just the demand for the metals is not what it used to be. In a robust economy, it would be much stronger.
Well, probably in the big sense, it's the lack of real profits out of the major mining companies and all the write-downs and such. It's been a rough past 2 years, and that's what's really keeping at least institutional investors for the most part out of it. For the junior retail investors, there's really been a lack of discoveries, and the few that, there's been very few that have actually been legitimate, that have lasted through and proved to be actual discoveries. So that's the other one, and it's just been a tough market. I mean, we're down 80-something% in the GDXJ over the past 2 years. That's hard.
Well, the resource sector, the juniors, are governed by four core narratives. One is the commodity cycle, which is where are the prices of the main materials, copper, iron, so on, trending. The other is the gold bug narrative, which is basically precious metals, gold and silver. Where are they trending? Are they trending higher? The third is security of supply, which is exotic materials such as tungsten and so on, which have all kinds of complex factors determining whether their prices are going to rise. And the fourth important one is discovery exploration. Now, on the commodity cycles things, we are in a bit of a slump right now because global GDP growth is sluggish, expected to be sluggish for a year or two. There is big response by the mining companies to cut back on their development plans. That puts in place another supply-demand imbalance in 2017-18, which means that's when the commodity cycle turns positive again. But meanwhile, there's not much appetite and interest for advanced base metal type projects. So the juniors are kind of stuck treading water, being treated as optionalities. In the case of gold, well, there is no fiat currency debasement happening in the US dollar. It's rising. There is no hyperinflation. We're in a deflationary environment. So the key talking points are basically on hold right now. And at $1,200 gold, most gold projects owned by juniors do not work very well. But then again, their valuations are low and they represent excellent optionalities on higher metal prices. And in the security applies stuff, we're still suffering the legacy of the rare earth bubble. People are reluctant to get interested in this again. And the problem with discovery exploration, in this type of bear market is when juniors should be drilling fantastic targets in that and coming up with that winning hole that suddenly switches the glass half full again and brings retail audiences back in the sector, creates mystery and excitement. But the system is so capital starved right now. Those who have money are reluctant to spend it because they're not sure that they can replace it except in the event of a barn burner hole. And barn burner holes usually do not happen with the first couple holes drilled.